Most traders don't even realize when they're walking into a trap that might set you back weeks or months in your trading journey. And it's happening right now as you're staring at these charts this week, likely completely unaware of it. So in this video, I'm going to hopefully save someone from going down the tilt death spiral and avoid the phase after that where you doubt your ability to trade and likely consider walking away. Because what if the tilt, the FOMO, was caused by a slow and continuous trigger that happened once a month? Much like the leak in a ship, a small leak that goes unnoticed until it's near emergency status. Now, I too have been feeling on top of the world one week, thinking to myself, this is it. I'm going to finally break through in my trading, only to have the complete opposite thought a week later. Now, why is that? What happens? Well, 1 year ago, that was exactly the case for me. I was finally getting into the groove on my first 250K funded account, working my way up to payout status with a near 80% win rate for the month. Now I felt unstoppable. But then the first week of April, I gave it all back in 3 days. Gains gone, account in drawdown, and my confidence was shattered. Now, I stepped away and I really doubted if I could do it. I questioned my model. I spent the entire next month plus backtesting, only to oddly find out that I was profitable again in backtesting. So, 2 months later, I timidly started trading a funded account. But the problem was that experience of giving back months of work in 3 days left a scar for me. Now, if you've experienced that pain, let me know in the comments. I'd love to hear how it impacted you. But here's the thing, that experience of working real hard only to give back the gains in a short amount of time repeated, almost as if it was on a monthly schedule. And what's worse than the lost gains is the mental pain of thinking you'll never make it. You'll never be free. You'll never be able to tell your wife and your family that you've paid the bills with this pursuit called trading. Well, there is hope, because since that blowout experience, I have now had enough experience and time in the live markets and in backtesting to identify exactly what that pattern is, and I've developed my own trading principles that have kept me from blowing out like that ever since. You see, there are two mental modes that every trader needs to have built into their trading system, no matter the model and no matter the market you trade. And we'll get into those two modes in a moment. But first, let's dive into the two events that trigger account meltdowns that I now look for and exactly what I do to prevent that and preserve capital. All right, so here we're looking at MNQ on the 1 minute chart. And the thing that I want to show you here real quickly on these charts is how effing ugly this price action is. You can tell by simply the tails, the wicks on the candles. You see how large they are in both directions. You see how over a large period of time, price simply isn't moving. It's not distributing. It's not expanding. Okay. And what's real important here to understand is that our edge, in other words, our win rate and our expectancy, it's built off a lot of things, but one of the big things that it contributes to it is the environment in which you are trading. In other words, what's the market doing? What are the conditions of the market? Because in poor market conditions, your win rate will likely drop significantly. I know for me, my win rate can drop by a third or as much as a half in poor conditions. And that's a significant piece of data. And if you haven't seen it for yourself, I recommend that you go do some backtesting and backtest through crap and see what your win rate is, like this, and backtest through good conditions where price is making very clear distribution. What's that look like? Well, basically, it just looks like if we're seeing, higher highs and lower lows in a bullish market. Is the market doing this really nicely? And obviously, this is a small time frame, so this is a lot of back and forth, right? It would look a little bit more like this. Let me actually kind of make it to scale. If the 1 minute chart was doing this, I would know we're in good price action, right? But instead, it's just sideways and chopping. So what's going on here and what are these two triggers? Well, at risk of sounding like an old man here, really it comes down to this. The two things that you need to look out for are non-farm, the news event non-farm, which you can see it in Forex Factory calendar. And then even last week, FOMC. All right, we had FOMC last Wednesday. And this week, we have non-farm. So let me get back to that. What does that mean? What I have found is that in my time in the markets and my extensive backtesting, price does not behave the same as it typically does on these 2 weeks. And currently, we actually have them back to back in conjunction with new all-time highs and in conjunction with the Iran conflict. Now, what I don't want to do is I don't like the traders that sit there and go, price action's always garbage, because it's not true. If that was the case, I feel like I would be a red on the month. There's always good price action inside of bad price action. We just need to have the filters in place to know when price action's likely going to be poor. And as I just said, if we know that our model is going to win less by a significant amount in poor price action, well, then we need to do something during those periods of time when there is poor price action. It's very similar to the idea of like, don't put liquor in front of a recovering alcoholic. Like it's just going to make it tough on them, right? And so as traders, we want to create rules and criteria and avoid the conditions that are going to cause us to take losses and cause us to tilt, especially in conditions like this. Sometimes FOMO trading works out in your favor because the conditions are good. You take a loss, and then your next trade you FOMO into that, and it works out in your favor. You got your loss back. You're happy with calling it quits at break even for the day, and you walk away. This is not the kind of price action that's going to be conducive to that. This is the kind of price action that's going to produce loss after loss after loss, and it's going to produce a significant amount of emotion. So, one thing I want to show you real quick is I've tracked this data, and I've even gone through like the most recent. Let's just look at FOMC because they're both nearly the same. FOMC is a little easier to understand, and then I'll show you NFP. But like looking at the last 1, 2, 3, 4, 5, 6, 7 FOMCs. And you could go further back, and it's probably better to do. But what I wanted to see is like with the current market conditions over the last year or so, what are the FOMCs doing? And what I found is 0% of the Mondays on FOMC were actually worth trading. 50% were worth trading on Tuesday, and only 20% were worth trading on Wednesday. So what would you do with that information in hindsight? Like realistically and logically, you'd be like, well, yeah, I probably shouldn't trade if those days are going to be that unlikely to present an A+ model that wins. I'm pretty, maybe I'll trade Tuesday. Maybe I'll try Tuesday, right? But what happens is when it becomes real time and you're in the markets, then you're like, well, you're just sitting around for the week. So we need to install processes for that, because the reality is, and let me show you NFP real quick. Similarly, I've broke down NFP weeks by AM and PM because I also wanted to see if the PM sessions were worth trading. And ultimately, you can see PM sessions not even worth touching the week of NFP. So don't trade them. And then if we look at Monday, actually Monday's pretty good typically. And so is Wednesday, and so is Thursday. And we can see an anomaly where Tuesday tends to be the lowest probability AM session, okay? And then what we can also see is FOMC Friday, not worth trading. AM and PM sessions are just garbage. So I have this information here. What does this mean? Well, two things. It means, and one thing we need to understand when I'm talking about trading modes, the two modes of a trading model is, let's look at, let's go here. Cool. So here's my live P&L for April, March. Here we go. March and April. Don't think this is all of my accounts actually. It isn't, but it doesn't matter. So this was a really good month in March, okay? Like you can see I did really well. I was green on every week. And that's the mode of that. So the two modes of trading are basically, and I don't have any like fancy terms for them yet, but ultimately trade away and capital preservation. And we need to recognize that different weeks provide different modes for trading. And the month of March was very much a trade month. You just trade and take your wins and take your losses and see where you end up at the end of the week. But what we ran into a little bit is the week between. So this last few days of March and this first few days of April, look at that, pretty much break even on the week with just a couple of attempts. That was a week where nothing very nice presented, and it was more about capital preservation. Here's a week where I traded, because you can see I took the trades, but slightly red. Okay, pretty much break even on the week. And then this was a week here. You can look at that profit. It was a good green week. The markets were trading nicely. It was a week to push for profits. Same thing with week 4. Like, it's okay. But look at week 5. This was FOMC week last week. I didn't take a single trade. And when I looked back and I reviewed the week, there was also not a single trade where I would have been okay with taking. There were a couple A- setups that won, but for those 2 A- setups that there were last week and during FOMC, there was also probably 8 or 10 losing A setups. So you can see it's important that we have a secondary mode of capital preservation. And that's the mode that we need to flip into as traders when it comes to FOMC week and NFP week. We need to not necessarily not trade it, but we need to install guardrails, right? Guardrails to keep us on the track so we don't blow out and screw up too bad. Because even what we can see here is if we look at NFP, typically the Mondays, 71% of them have been worth trading with an A+ high A grade model that won. Now, that wasn't the case here today. So how do we do this? Well, first off, I think it's important to go into both of these weeks with specific rules that are added into our system. We all have our trading rules, what session we trade, the model we trade, what we look for, how many losses we can take, those kind of things. When it comes to not blowing out accounts and going on to tilt and destroying accounts, these are the 2 weeks that are most likely to do that. So we need to sprinkle in a couple more rules, okay? And I have different rules for NFP versus FOMC. We'll look at NFP because that's the week we're in currently. So for me, my added rules is I trade Monday through Thursday in the AM. Tuesday's the lowest probability day. I need A+ price action, and I need an A+ model. PMs all week are low probabilities. Skip. NFP day, skip. Okay, cool. So I already know my trading time is reduced by 50% this week. Okay? And we can even look at FOMC because I know that, maybe I need to zoom in a little bit on this. Let me see. Format, view window, view, zoom in. There we go. FOMC was a little bit more, had a little bit more rules. Basically, Monday, I do not trade. And Tuesday, AM only. Wednesday, AM only, possibly, but I'm also not expecting it. Look at this. So Wednesday AM, 20% trade. And then even then, FOMC, Wednesday PM, only 33% of the time was there an A+ setup, okay? And then Thursday, very tradable. So I know FOMC Thursday, I'm going to trade. FOMC Friday, I don't typically trade that day. So I walk into these 2 weeks with different rules, different expectations. And when you do that, you're going to remove the slow leak that likely can happen when you walk into these weeks that are just lower probability. And I know it's boring. I know it's not sexy. But this is the stuff that can prevent blowouts. And what I typically do during these weeks, during FOMC week and during NFP week, is I just change my expectations, okay? I know I'm going to be doing very little trading. I know I'm likely not going to take a setup. So what I tend to do is I then add in backtesting sessions. We got to get in the reps, even if they're not real-time live markets. It's helpful to do the backtesting because what you can gather is years of data on your trading model and trading system. And I think that's something too many traders underrate is having years of data, especially as you're a newer trader. You're not going to have years of data in the markets, At this point, I have 1 year of data in live markets. But I also have 3+ years of backtesting data gathered that really gives me some insights into how my system works over time. And that's a whole nother video that I think could be valuable, but I'm not going to get into it. So I hope that's helpful. I want to wrap that up here again, just to succinctly remind you, our model is lower probability in certain conditions. And we should just really be careful about trading in those certain conditions. Those certain conditions are FOMC week, the entire week, NFP week, the entire week. I recommend you go into price action and study it. It took me, a matter of a few hours, like 2 or 3 hours to gather this data. And I think too many people are too lazy to do it. And I don't think the unprofitable people are doing these kind of things. They're not gathering statistics. They're not gathering data. Do that and see what your guardrails could be during those 2 weeks to help prevent account blowouts. So if that was helpful, give this a like. I would really appreciate it. And I'll catch you in the next video.